Right, good afternoon, and thanks for interrupting your lunch. So I'm going to start with a number. That number is 0.07%. Rather than talking about me and my name, that number represents the probability, expresses a percentage, that a mineral resource from a geological idea actually ever makes it to the concept of a proven economic assessment, so a PFS or bankable feasibility study. And that ultimately poses an incredible amount of risk to the average investor in the AIM market. Now, fortunately, in the AIM market, you do have a process of nomads who actually mitigate that risk through their due diligence, and you have shortening odds. However, in our experience, and my background as a geologist and an engineering and mining engineering background, you're always stuck with one company, one asset, and you're always committed to that asset. And being committed to that asset, if it failed, you had to go back to the market and raise more money or find funding for it. So Cadence is about investing and diversifying that risk and taking its technical capabilities and its technical know-how to develop assets in the battery mineral sector. And to date, we've taken that approach, standard disclaimer, and we've put it into two pots of investments. The first pot of investment is basically direct project investments. What I mean by direct project investments, I mean those that are non-public. We take up to 100% economic stake. We do it early in the development cycle, so that's pre-resource. And we do it early in the pre-resource because we can apply our technical knowledge, because this is where our expertise exists, to de-risk those investments. So we de-risk them by sifting through maybe 50 to 60 of these investments and maybe choosing one every 2 years. So we're not actively just buying shares randomly. And we take management positions on the boards of these private assets, and we also de-risk our investments on an asymmetric return. So what we try and do is, in effect, take small percentages early on, have no commitments going forward, and it's only if management deliver certain deliverables in terms of what we are seeing as value, i.e. resources, PEAs, etc., that we will then carry on investing. Then we have our public listed investments. So that is, we invest up to 30% in public listed companies. Sometimes they're on a different exchange and they come here. And two of those, and we leverage our know-how where we have to expedite the development of these, i.e. in particular, introducing them to particular off-takers if required for the end product, or on top of that, adding our expertise in terms of development of the asset. So we take early stage investments, we look at undervalued assets, they're mispriced often, and we invest in development and apply our management time and effort to crystallize value as quick as possible. So we're trying to look for almost a private equity type style return and management. And that's in fact what we've managed to do to date. You see our returns there have been, in terms of our investments, have been around 121% to date. And that has been over 3 to 4 years, which represents about 30 to 40% compound annual growth rate. So that too is us as effectively a private equity type model, and our involvement in management is similar. We also try to keep our cost structure in a similar manner. So if our investments go down, we will reduce our costs, including directors' salaries. But the interesting thing for me is the potential growth. So the potential growth of these assets, both in the direct project investments and public listed investments, could mean up to $130 million of value. And that's not me just speculating, that is basically taking our direct interest and indirect interest, applying an NPV, which is in the public domain, and attributing to us. So there's plenty of upside. This was at the end of last year, so those figures have changed slightly, but nonetheless, it shows the market capitalization of around 20 million, and will certainly appear overvalued on that basis. So you can understand who we are, how we do it, and we can apply that to any resource. But ultimately, we look at lithium. And you ask, why lithium? You've heard all about it, it's about electric vehicles, but I really want to talk about why people are getting it wrong. I called out Morgan Stanley on one occasion saying that effectively their forecast was incorrect, because they failed to understand two aspects of the market, and we'll go through that. I always use this slide because it tries to show what a disruptive technology, and the electric vehicle and the lithium inside it are disruptive technologies, right? And we just have to look at, this is Henry Ford's lawyer saying, don't invest in Ford, don't invest in internal combustion. It's a fad. And when you look at the Fifth Avenue Days Parade, and you look at where is the internal combustion engine, there's one of them. That's in 1900. That was the only internal combustion engine at that point in time. In 13 years, I dare you to spot the horse-drawn car. Well, there is one there. It's very hard to spot. But you go from a point in 13 years where you have an incumbent technology, -1, to it being completely replaced, -1, by new technology. And that is what electric vehicles are. But people fail to understand this, and experts fail to understand this on a regular basis. And I'll show you how they do that. Experts, and this is talking about the mobile phone. McKinsey were asked by AT&T to make a forecast in 1985 about the penetration rates of mobile phones around the world by 2000. They came out with a figure of 900,000 users around the world. It was 109 million users. It was a factor of 120 out. Now, they're really intelligent people. Why did they get it wrong? Well, ultimately, again, they failed to understand it's a disruptive technology. Admittedly, when you look at a cell phone then, battery lasts for 10 minutes, it was big, and why would you ever think it would turn into what we've got today in our pockets, which is this thing, you know, the mobile, the iPhone. So our electric vehicles have slightly been cut off, unfortunately. Our electric vehicles are disruptive technology. There are characteristics there. Those characteristics are essentially drops in cost curves. So those cost curves, if you look at the electric vehicle, primarily driver is the kilowatt hour, cost per kilowatt hour. 2005, that was around 1,500. It's sitting around $200 now. And it will be about, by 225, it will be at $100 or $150 per kilowatt hour. At that point, it's economic for everyone just to buy an electric vehicle, and it'll be cheaper than an internal combustion engine. At the moment, on a total cost of ownership basis, it's cheaper. And when you see many technologies within a vehicle or an overall technology converging, like cost per kilowatt hour, other drops that are exponential, you see S-type curve adoptions. And S-type curve adoptions are adoptions that mean at one point the penetration rate is 10%. Within 5 years, 10 years, that is up to 80 to 100%. And we can look at through history that's happened again, whether it be the book, the printing press, the printing press in particular, color TV, airplanes. These are all disruptive technologies, and they penetrated and completely disrupted the incumbent market. And that's what electric vehicles are. And when you start to see why that's going to happen, they're more efficient in terms of charging. They're more efficient in terms of maintenance, basically 10 times more. In fact, you don't even need to maintain them. And every time you see that, you see a 10 times improvement in economic cost. It disrupts the incumbent technology. So that's why I invest in electric vehicles, and why we invest in lithium, and why electric vehicles are so critical to us. And when we look at the supply and demand, you can see this line here, effectively this demand, is the demand of lithium carbonate based on electric vehicles penetrating about 23%, and you look at the supply. These are our own models, proprietary to us, and so we understand that there's ultimately going to be a deficit for lithium products. So that's why we've invested in lithium. You understand that we're investing in a very particular way. I just want to show you a bit about our assets. In essence, we have, so as I said, two sets of assets. The first, in red, are what we call the public listed investments, and they're around the world, geographically diverse. And the black ones or gray ones are what we call the private assets. The two most important public listed investments are our stake in Bacanora, which is around 8%, and European Metals, which is around 20%. Both of those have got NPVs between them of in excess of $1.7 billion. We have a stake in those, and we look forward to them progressing those and taking those to fruition. And we can then look at crystallizing our value. Bacanora is really important. The construction is anticipated to be started in 2018 with production 2020. I want to point out that these assets of Bacanora, which is in Mexico, and European Metals Holding, we invested in these assets when they were early exploration. So Bacanora, we started investing in 2013 when lithium wasn't really heard of as a fashionable element, as it were. So we take that risk. We take the risk from early stage exploration, resource definition, and we look to divest and crystallize our gains later when effectively we don't have the capital to contribute to a $400 million build. And European Metals, again, that's about 18 months. So those two projects are key to the cornerstone and underpin our value right at this point in time. We then have our black assets, the direct project investments, where we have a JV with Bacanora, in fact, in here, which probably has an NPV value to us about 30 million. And we're keen for Bacanora to develop that asset because that will get mined in the process. And more recently, as I talked about, reinvesting, we invested early in the cycle in that Argentinian asset here, which is a highly prospective pegmatite exploration asset. A bit about the key investments and what we look for in those. We look for size, low cost, and location. Size being those two assets, Bacanora and European Minerals, are the two largest non-brine assets in the world, or one of the two largest, rather. And we've been involved with them since they really weren't recognized. Their cost and their operational cost per ton of producing their final product, lithium carbonate, is in the lower half. CapEx, this is typical CapEx. Bearing in mind the one that I quote there of $800 million for Bacanora, that's for their total plant, not for their initial plant. So, in fact, it's half of that initially. And their NPVs are excellent, IRRs are excellent. I also note the lithium carbonate price we use. They're used in that. $10,000, $11,000 a ton. The current lithium carbonate price is $16,000 a ton. So there is upside still, even on those prices, for that to occur. So we're excited for both of these assets. That's the type of asset we target and hope to develop and be involved in going forward. I talked about strategic location. European Metals, given that 23% of the batteries going to be built in the world and where the plants are committed to are going to be in Europe, European Metals is absolutely critical to that supply chain. And we want to see them develop and take that to production. As I said, I think they're about 18 months behind Bacanora in that regard. So we talked a bit about the San Luis. We sort of talked, these are our direct project investments, and I just want to talk about one of them. This is the San Luis project we got involved in very recently in December. Why we like it? Well, Argentina is very well known for its lithium production. It will probably represent 23% of lithium production in the world, so it's a stable environment to invest in lithium. We've got 6 prime assets that are coming up for, basically, we've applied for them. The license will be granted. And they're in an area where historically there's been excellent grades mined from lithium oxide. Now, the great thing about this is we're only exposed if our partners are successful. Licenses are not granted, our sunk costs are about a couple $100,000. If they are, then we continue to contribute and take it. We have the option to go up to 100%. Now, it's all very well talking about this, and what does that really mean, and what could it mean? I can't put it on my larger slide because there's no quantifiable economic study. But if we look around the world at these type of assets, and if we were able to target something about 25 million tons of ore at about 1.2% lithium oxide, which is about 750,000 kilotons, 750,000 tons of lithium carbonate equivalent, the enterprise value of that would be 300 million. So our target is to find some of these assets early stage, develop them, and take them through that value chain from where we're investing 1 million to 2 million pounds over a period of time to take it up to 300 million in terms of enterprise value. And that's just data based on multiple other, as you can see there, lithium sort of hard rock producers and their enterprise value. So I haven't taken the highest one. We've taken a median. So it's around the $200 a ton. So there's real potential there, subject to getting these resources defined. So when you look at us, again, I'm putting it up there. We're poised for an upside, I believe. We have 2 catalysts in Bacanora and EMH. Bacanora is really going to construct its mine, which is a catalyst for value for us. Even now, at the end of last year, our market cap was around 20 million, and we had an asset base of 33, and returns have been good. But if these 2 assets, especially across the board, EMH, Bacanora, in particular, come to fruition, and we're still there on a diluted basis, that's $130 million to us. And that's not even talking about any new assets that we would reinvest in to achieve similar returns again. So I think that's really the end of it. Just to talk about who we are. I'm the CEO, clearly, and my background's technical, and the rest of the team involved, in particular, Andrew and Adrian, are fund managers, and they provide sort of a bit more sense to some of my technical musings and what is going to be able to be marketed and capital raised for. So I think I've tried to make that as short as possible, and if there are any questions, we've actually got a bit of time now, 2 minutes. I've got 2 minutes. If there are any questions that people feel free to ask them now. Yes, hello. So the question was, where do I think, personally, Bacanora will get its funding from? Now, if we look at what has happened historically, we look at Nemaska, we look at some of the history that's happening in that. I mean, even back to 2013 when Galaxy was getting funding. It's not a traditional debt 70-30 type debt equity with cheap debt. It's not a commodity, so you'll find that they'll either get funding from, they'll certainly get funding from their, I assume, their own supportive shareholders in terms of their major shareholders, BlackRock, etc. And then there will be some debt, but I think we're not going to see 70-30. And if you look at Orion, who funded Nemaska, I mean, I internally worked that cost of capital out on a debt basis around 15 to 20%. So I think, you know, it's not going to be cheap financing, but ultimately, it's absolutely critical to get that financing and move forward. Because Bacanora will be the next, in my opinion, well, in Cadence's opinion, will be the next lithium carbonate producer off the mark. Anything else? Yes. So our current cash reserves, well, obviously at the end of the year, we're around £1.5 million. So, look, we don't have no intention to make any new investments, so we should last in excess of a year at the moment. We haven't raised equity for 2 years, and our idea is to effectively, over periods of time, crystallize and reinvest, and keep our cost structure down to sort of what you'd see in a private equity, which is try 3%. We're not there yet. We're probably closer to 5%, but bearing in mind our net asset value, we've all, you know, including the board of directors, we decided to take about a 30% pay cut across the board, given where we stood with our market capitalization, and we still invest. So at the moment, I'll be investing on a net basis, i.e. after tax, I'll probably be investing about anywhere between 20 to 30% of my salary in the company this year. It's around 17 million at the moment. 17, yes. Well, as an investment company, so we do post profit, but they're not cash profits because we mark to market our book. So I think last year we had, well, the year before the accounts we published, we had around a £3 or £4 million net profit. But that's not cash profit, that's marking to mark our book, because the performance, as you've seen, has been pretty good, 121%. Large majority, in fact, there's probably about 1, 2 small family funds, but I would say in the region of 70, well, in excess of 90% are private shareholders. 90%, in excess of 90 are private shareholders. Yeah, so we did what we call a Section 808 on our register. We have in the region of 10,000 to 15,000 shareholders on the 60, yeah. So we have some institutions, but they represent less than 5%. I think we've run out of time, and that's perfect. Thank you very much.